All right, traders, here's a quick video on the trade idea that we sent out yesterday. This is on Delta Airlines. If you remember, Delta reported last week and they had really good numbers. They raised their guidance for 2018. So, number one, that catches my eye, really strong earnings. And, now we have that data point and earnings are behind us for this name. So what did we see after they reported earnings? We started to see some call buying that day. It kind of was the afternoon, and we saw some further out call buying going out to June. These orders caught my eye. And if we look at the time of these, which if I can find these, yep, right around 2 o'clock, a little bit after 2 o'clock, so that's 14:13 and 14:14. We saw the June 60 and June 62.5 calls that traded. Pretty decent amount of premium here. These 60 calls went up for 325. If you look at in terms of option premium, that's $846,000. And then there was another trade that went up right after that at 1 million. So someone's got conviction. Again, these are sweep opening trades, right? So they're aggressive trades. It doesn't look to me like this is hedging. So what I notice as well, as you could see in the chart, is this name, Delta Airlines and some of the airlines have been kind of a tricky trade for the most part, but there's some big investors like Warren Buffett and some of the airlines, and really what I like is this breaking of the trend, this upward trend line, which is kind of sideways, but has definitely an upward bias to it. Notice that we just broke out here of this upward trend line. So if you zoom out, you could see this. We did have a nice move here. But I think there's more upside, and especially by the look of the option activity post earnings, to me it looks like a pretty good setup. And again, whenever I look at a setup, I always want to know where it's not going to work. So if the price action breaks back below the trend line and maybe into value for the month of January, so you've got this marked here. 56.85 would be your level to the downside where the trade doesn't work. But for now, I want to try to play the upside. So seeing that we had a bit of a down day yesterday, where we started the day higher and closed lower, sets up pretty nice for me for putting on this trade. Again, not catching it right on the earnings day, but a couple days after earnings, which is fine. Sometimes I like to let things settle down. And what we did is, which this is new. This is what's called a limited risk reversal. And if you're a trend trader, this is, to me, is the right way to play options using with a trend trading philosophy. So, and I'll explain a little bit further here, but put down the price here, and the structure of this, why it's called a limited risk reversal, is if you go back to what a risk reversal is, it's basically replicating a stock position, right? Normally, if you're bullish, what you do is you buy a call and sell a put, right? And that the selling of the put finances the purchase of the call. Depending how you set up the strikes, it could be perfectly at zero cost or could have some debit price to it. But basically, you're replicating you're replicating a stock profile, right? When the stock goes up, you make money. When the stock goes down, you lose money. So what a limited risk reversal is you're capping your downside risk. So you still are purchasing a call, which what I did here is I purchased the June 65 calls. So I went out to the same month that they did, but I went out up a little bit further in strike because I do think spending around 325 or 237 is kind of a lot. And then what I did was instead of just selling puts, where I have risk all the way down to zero, what I did was I sold a $5 wide put spread. So this way, I'm capping my risk to the downside, and I'm basically taking the sell price, what I'm receiving when I sell a put spread, which is the June 57.5, 52.5 put spread, and I'm collecting $1.65. When you net this with the price of the calls, my outlay is 16 cents. So it's almost zero cost. It's pretty close to it, and that's how I wanted to structure the trade. So if we look at the profile, and you could see what I did was I included the profile from E-Trade to see where basically it's flat for a while until we get to around $65, and it's basically So this is assuming going out to June expiration. How would this look? And that's where you get this this diagram of the of the straight lines on here. So what this means is, we always want to look at the downside first and where we could lose money. So I did this for a 3 lot, but let's just talk about it in terms of 1 lot, just so that you're, in the simplest form, what your risk is per every 1 lot that you put this trade on. So if the stock price goes below the lower strike on the put side, that means that you'll lose the whole $5 plus the 16 cents, which it costs for the whole structure. So that's the worst that you could do in this trade, is you could lose $516 per 1 lot, right? So you're capping it. And again, if you go back to a trend philosophy, is what you want, whatever you trade, but also in a trend philosophy, is you want big winners and you want small losers. So per 1 lot, this kind of seems like a small loser to me, losing $500, the worst that you could do in this structure. If the stock ends up by June expiration between 57.5 to 65, it's basically a null, right? You'll lose the $16 that cost to put the structure on. So the break-even price is 65.16, again 16 cents above the long call. Anything above 65.16 is really where we want to see the stock out. Basically six months from now. If it gets to above, let's say even, I kind of put I put two further outs prices, 70 and 75, which is a decent price from where it is now, but that's really where we get into the money above 65.16. And you could see the diagram here as it will go up pretty nicely here. And whenever you're looking at one of these structures, the curved line is what the price will do, not at expiration, right? So it's a little bit different, but the straight line is what it will look like all the way by June expiration. Okay, so that's the trade that we did yesterday. Again, we've been seeing a lot of call buying in this group. I think the chart sets up well, and then we're basically putting on a trade very close to zero cost. And if it starts to move up heavily, we've got a very nice trade. If it manages to kind of stay around and chop around, then we don't lose much either. Where we would really lose money is if it starts to sell off pretty hard. But looking at the data point that we just got for earnings, to me it sets up for a nice risk to reward setup. Thanks for watching the video. And this is what we're doing every week now. We're putting out at least one of these trades where it's a limited risk reversal, different structure, really nice for those traders who are trend traders and who are looking to do a trend philosophy in options. Thanks for watching the video. Have a great day.